okay, the uptrend is now over, it's stalled out, and it's actually started a downtrend. And that's when I get out. And that's a big difference between a lot of investors. Is showing weakness, it's leading the way to the downside is not good, because the Nasdaq is a heavyweight boxer. And when it goes down, man, it pulls the other indices down with it, because it has the Mag 7s in it, and it's very heavily weighted with some big players in there. I think it's a gamble. I think you might get a bounce, and it all depends on if it is a bounce or if it is going to get legs and want to go higher. But based on, global things happening, precious metals, what they're doing, the volume, the sentiment of people, cycles that I follow, it's more or less pointing to this time could actually be the top before we go through a multi-year recession. Of the S&P 500 here, and it's really been trading in a pretty big sideways range for a while. When we look at this price action, you can see here it keeps kind of moving to an upper range and then a lower range. I mean, it's been slowly drifting higher, but we're starting to really run out of upward momentum. Now, it's so close. Just a few sessions ago last week, we almost hit all-time highs, but it ended up selling back down. We got some big waves of selling in various different sectors, which I think you and I'll probably touch on later. But when we look at the S&P 500, it doesn't look the healthiest. Now, it is still in an uptrend. We are actually long the S&P 500 here still, but it really does need to find traction in the next few trading days. And there's a lot of things that are pointing to the markets wanting to break down based on what precious metals are doing, based on what specific sectors in the stock market are doing. So it feels a little bit like a coin toss right here if the S&P 500 is going to actually be able to hit all-time highs or not. And at this point, it's looking pretty bleak because of some other big players and big stocks that are definitely lagging and pulling the market down.
Gotcha. Okay, well, we'll get into that some more. I'm interested to hear your rationale, though, briefly. Why are you still long if you think that things are starting to look a little bit bleak for the S&P here?
Yeah, so I mean, I follow technical analysis. I don't follow news or fundamentals or emotions. And so when you look back on this chart, I'll just get this moving averages to load. You can see the moving averages are still layered properly. This long-term moving average, this green one, is the 150-day moving average. It's still sloping up. So the stock market, I always look at the stock market like the ocean. When the tide goes up, what happens to all boats? And so it's the same with the stock market. If the stock market is in a rising tide, pretty much most stocks are going to want to go up. And you don't want to bet against a rising tide. It's pretty much a force to be reckoned with. So right now, the underlying trend based on the 150-day, based even on the 50-day moving average and the 20-day moving average being above it, it's still telling us the trend is still rising. So the market is taking a big breather. It is showing signs of weakness. It is a concern, but I don't change positions until proven wrong, until the trend says, okay, the uptrend is now over, it's stalled out, and it's actually started a downtrend. And that's when I get out. And that's a big difference between a lot of investors.
Technical analysts focus on trend structure, not emotions. Long-term moving averages for the S&P remain upward sloping, suggesting the broader tide hasn't fully turned. Markets, like oceans, lift most boats when trends are intact. However, shorter-term signals tell a different story. Momentum is fading and sector leadership is narrowing. Historically, major downturns begin with subtle deterioration before price confirms it. The key principle here is patience, riding the middle of trends rather than guessing tops or bottoms. But if the underlying structure cracks, history shows declines can accelerate far faster than advances.
The Nasdaq definitely showing a lot more weakness. We're seeing a lot of big tech, SaaS and Magnificent Seven, all of that starting to break down. If you were to take a look at kind of a key pivot zone across this chart, if we look at this upper range here, price is generally kind of bouncing above it. And now price is actually kind of broken down and it's bounced up and it's hitting its head on resistance here. So this is definitely not a good sign. And it's actually making a series of lower highs. It's making a series of lower lows. That is the definition of a downtrend. And so the Nasdaq is in a short-term downtrend, whereas the S&P 500 is still kind of holding up from a technical level and cycle level. The Nasdaq has been rejected. We have the 20-day moving average breaking below this 50-day. These are all a lot of technical lingo, but more or less, moving averages give you an idea of long-term, short-term, and very short-term trends. And so we definitely have the Nasdaq in a downward bias. It hit resistance. It got rejected. And the next significant support level is going to be somewhere right across here, around the 24,400 or 500 level for the Nasdaq. If it breaks below this, we're going to see a very precipitous fall. And of course, if it breaks down, then we're going to see the S&P 500 break down. They pretty much move together. But the fact that the Nasdaq is showing weakness, it's leading the way to the downside, is not good, because the Nasdaq is a heavyweight boxer. And when it goes down, man, it pulls the other indices down with it, because it has the Mag 7s in it, and it's very heavily weighted with some big players in there.
Weakness is far more visible in the Nasdaq Composite, where technology giants are losing leadership. Many members of the so-called Magnificent Seven have shifted from market drivers to market drags. Lower highs and lower lows now define the short-term structure. If this continues, broader indices typically follow. Major bull markets often peak when leadership narrows and speculative enthusiasm fades. Similar patterns appeared before the dot-com collapse and the 2008 crisis. When heavyweight sectors roll over, they rarely do so quietly. The concern now isn't just volatility, it's structural deterioration spreading beneath the surface.
I do feel like I do feel like it's going to be very similar. There's going to be a very precipitous fall in price. Believe it or not, this tariff drop in the Magnificent Seven and the Nasdaq and in the stock market in general, I overlaid it once with right here. If you check this out, so this is the April sell-off you just talked about, John, the tariff drop of last year, and then take a look at COVID. And this is why, a lot of people always have this story in their head, and you hear it all the time. Everybody's like, this time is different. It's different news. It's like, everybody's like, it's always different. If you look at all of these drops in the market, you can go back to all kinds of them. They almost look the same. It doesn't matter if it is somebody changing some tariff rules or if it is a global pandemic. Price does one of two things. Either people are buying it and it's going up, or they're selling it. The stock market doesn't really care what the news is, and every correction is different. And so people are right when they say this time is different, but price still does the same thing. And so whether this time is different on some different news, I totally think it is going to be different news. I think we're going to start to see the AI bubble unfold. I think we're going to probably see poor economic data potentially start to roll out, and we're going to see another big sell-off. And I do feel like this time around is not just a buy the dip. I think the market could fall 20% here very easily, the mags, the Nasdaq, and it might have a strong bounce after that. But I do believe we are actually headed into something much more significant in terms of the market sells off and then eventually puts in some bounce. But I believe we're going to go into an economic reset, and it'll actually form probably some big topping pattern, some head and shoulders formation. And then when we break that neckline, we start a stage 4 decline, which is a financial reset. And that's when, unfortunately, it'll feel like 2008 again. It'll be layoffs galore, unemployment spikes. Things will get really, really tough. And so that's what I see unfolding in the big picture. So do I believe this sell-off can be bought? I think it's a gamble. I think you might get a bounce, and it all depends on if it is a bounce or if it is going to get legs and want to go higher. But based on, global things happening, precious metals, what they're doing, the volume, the sentiment of people, cycles that I follow, it's more or less pointing to this time could actually be the top before we go through a multi-year recession.
During global downturns, diversification often provides less protection than investors expect. In true stage 4 declines, the final phase of a market cycle, correlations rise sharply. In 2008 and again during the 2020 crash, nearly all equity sectors fell together. Even traditionally defensive dividend stocks suffered deep drawdowns. When liquidity dries up, investors sell what they can, not just what they want to. Emerging markets may lag or lead briefly, but sustained bear markets tend to synchronize globally. The hard lesson? Owning different stocks doesn't shield portfolios if the tide itself is receding.
I've gone over this many times with in other videos with subscribers and stuff. What's really interesting is, yes, there are times where emerging markets, international markets can do very well. They can get away from the US and find a bid, just like we've seen here. But what happens is when we enter what I call a stage 4 decline, and a good idea of what a stage 4 decline is, if people don't know, this is a diagram here. There's 4 stages to the market. Stage one is a base. You kind of want to avoid it. It can go on for decades sometimes. It's wasted time. Stage two is a bull market. You usually have a blow off top. And then you get into a stage three. It's very difficult. It's where we're at now in the stock market. And then we go into a stage four decline. And that is a financial reset. And it's what resets the economy for another 5, 10, 15-year bull market and economic kind of boom. And we'll come out the other side. Stage four, I shade green because there's huge money to be made in strong trends. It doesn't matter if it's to the upside, a bull market, or to the downside. If you understand and can follow price, you can benefit on both of them. And the nice thing about a stage four or a decline is the stock market actually falls 4 to 7 times faster than it rises. So there's big opportunity coming around the corner. Now, what happens here is when the stock market actually enters a stage four decline, not just to buy the dip, but I mean an actual financial reset where the economy tightens up, companies, individuals close their wallet and they brace for survival, financial survival. We see all of the international markets move in sync. Now, the stock market in the US might top and roll over first, but usually within 1, 2, or 3 months, all of the other major indices around the world follow suit. You can overlay them. Either we're all in a bull market or we're in a bear market together. Just some of these other emerging markets and global indexes can kind of lead or lag a little bit, but they will get pulled back and they will sell off. I mean, we saw a very strong move up over here. We saw the US market correct. In fact, the emerging markets were already starting a bear market a year before the US, and then the US hit and pulled it down for the second half. And I don't know how far back this actually goes, but you can see 2008, same type of thing. We saw emerging markets doing exceptionally well. Then they sold off and they crashed. So this is one of the biggest misconceptions I think people have is people think, oh, if I get diversified, if I have hot sectors and I got mining and I've got international equities, emerging markets, all of that stuff, I'm diversified, I'm good. The thing is, they're all stocks. And look at the stock market like the ocean tide. It doesn't matter what boat you have, you're going up with the tide or you're going down with the tide. So diversifying is just buying a whole bunch of more volatile individual assets that are going to actually move a lot faster up and down. And so when the market goes down, people have diversified away from just the indices and they got all these hot sectors and international markets. They're actually holding a whole bunch of ticking time bombs. Don't realize they're the ones who actually get hit harder than somebody who just has an S&P 500 ETF that corrects. And a really interesting example of that is, let's just go back to 2020. If we take a look at this crash here, take a look at this. This is what people don't understand, the risks that they have in their portfolios. So this is the S&P 500. During COVID, it fell 35%. And now most people would say, well, just holding the stock market's pretty volatile. Retirees are like, no, give me something stable. Give me big blue chips, big dividend paying stocks. And so let's just go back to what the dividend stocks did in 2020 during the crash. These people who think they're protected, they got the strongest companies paying dividends, they lost almost 50% of their portfolio thinking they were holding the most safest, strongest company.
Precious metals are sending mixed signals. Gold's long-term uptrend remains technically intact, yet short-term price action shows signs of exhaustion. Silver, by contrast, experienced a euphoric surge followed by sharp reversal, a classic blow-off top pattern. Extreme sentiment often precedes reversals, and volume spikes suggest distribution rather than accumulation. In major liquidity events, even safe haven assets can decline as margin calls for selling across the board. Historically, metals recover over time, but not without volatility. If a broader reset unfolds, gold and silver may first endure sharp corrections before finding sustainable footing.
I mean, both gold and silver have had a perfect stair-step price action to the upside. We use Fibonacci targets. We've played moves to the upside. We've got each leg kind of running up. And it's interesting because the target that we had for silver was 106. And I remember I was in Vancouver at the VRIC event. I was speaking there and I talked about gold and silver. And I said, once, based on the sentiment, based on momentum and the technicals, once silver, and if silver breaks 106, it is going to go into a kind of a feeding frenzy, a blow off top, and we could see 120, 130, 140 get hit very quickly, and then it's going to reverse and crash. And it's funny because I was on stage as this was happening, and it exploded through there, and now we've got this reverse in price back down, and so huge volume. A lot of damage was done on this chart. In fact, gold has been forming a high momentum kind of bear flag pointing to lower pricing. Silver just is refusing to actually find a bottom. And when we look at the downside target on silver based on the high all the way down to this low here, and the strength of the bounce, which was a very weak bounce, it is pointing to very low pricing for silver. It's pointing down to around $28. So again, this is the halfway point. You have the move down, you have the bear flag pattern, and then you have the second half of that move. And so I'm not saying it's going to go down here, but that is definitely what the charts are pointing to. I think we could see it very easily go to $50. This orange line is the 618 extension. This is called the golden ratio. This is the first level that price is most likely to hit. The 100% is a little bit more of a stretch, but we could easily see silver hit $50. And the fact that that is a golden ratio value, that's telling us just based on sentiment and momentum, it should find a bounce there. And that bounce happens to be on $50, which is a whole number. And people love to buy on a whole number. If you're above it and it falls down to that number, 50, it's just a round number. It's just a number say, oh, if silver ever fell to $50 again, I'm going to buy some more. That's the mentality of these whole numbers and what investors have. So I think we're going to hit that $50. I think it's going to have a strong bounce. There's going to be a lot of bargain hunters, people stepping back in. And the question is it a bounce or will it actually be a bottom? We'll have to kind of watch how the price action unfolds. But when we look at the volume on this chart, we saw more or less huge volume on the peak. And what's happened here is prices kind of continued to, our volume has kind of gone down, while prices kind of traded sideways. And that's just telling us the big sellers are taking a breather and they could step back in at any time. And once we start seeing some big volume spikes again, that could be another big wave to the downside. So silver's looking pretty bleak. And, there wasn't that long ago, everybody was like, oh, if silver ever crashes again, I'll buy the dip, right? Everybody was a silver stacker and buy the dip. But the mentality's changed. If I give any bearish points on silver now, everybody, obviously doesn't want to hear it. And they say there's no way it's going that way. It's going higher. But, not that long ago, people would have said if it ever crashed back down to 28, I would buy more. And I see this as an opportunity. I sold all my physical metals. I sold silver at 113. I sold a bunch of gold up there. I've completely cleared out all of my physical metal positions. And what I want is this financial reset. I want to see gold and silver get pulled down with it. It's typically what happens. They are not immune. They will get sucked down with a financial reset, margin calls, all of that stuff. And it's going to provide an amazing opportunity to, get involved and play the move again. I do believe gold will be, $7,500, $10,000 years from now. Long term, I'm very bullish on metals.
If a full economic reset emerges, opportunities will shift dramatically. During prior Stage 4 declines, including the 2000 tech collapse and the 2008 financial crisis, defensive positioning, cash reserves, strong currencies, and even inverse strategies outperformed. Markets typically fall 4 to 7 times faster than they rise. That speed creates both risk and opportunity. The coming years may test investors' patience more than their courage. Whether central banks intervene or not, global tightening cycles eventually overpower stimulus efforts. The key isn't prediction, it's preparation. Trends change. When they do, survival becomes strategy.
Our position overall, when we look at the market, is really just equities based. So we're about a third of our portfolio in the S&P 500. We were in the Nasdaq, but it's just stalled out. It's just been trading sideways. It lost its upward momentum. And so we've closed out our Nasdaq position. And we hold a big cash position now and really waiting to see when we get the next signal. So we've closed out our precious metals, closed out our NASDAQ. We're just waiting, cash rich with a third of our portfolio in the S&P 500. If the equities market does get rejuvenated and we see the S&P 500 break to new highs, we see the NASDAQ pop and break out and rally, Then we'll get re-engaged and we'll add in, and we'll probably get long the Nasdaq or maybe even the TSX, the Toronto Stock Exchange, which is, there's an ETF to trade the Canadian market. Typically in this phase of a stock market, which is kind of a late bull market stage coming to an end, we tend to see the Toronto Stock Exchange do well because it's resource rich. It's heavy in energy stocks, precious metals. Naturally, commodity-driven stocks do very well just before the economy kind of comes to an end. And that's what we've seen. Precious metals are at all-time highs, energy stocks at all-time highs. These are all things that signify that we are in late stages. If we actually look at the cycles in the markets, we usually see precious metals outperforming. We see energy stocks, which we have energy stocks doing the same thing. That usually happens just as the stock market's putting in a peak, and then we go into a correction. So there's a lot of things unfolding, and I'm all about protecting our capital, protecting our time, protecting our lifestyle first, and then I work on growing it. So I'm not going to take risks and hold assets that are falling in price or are directionless. I will re-engage and get back involved once a trend picks back up. So right now we're just waiting, cash rich with some equities, and we've locked in gains on all of our positions and letting the market tell us which way it wants to go for now.
Gotcha. Okay. Well, that's helpful though, because it's like, having a pile of cash is one thing, but then when you use it and how, I think it's helpful for people to think through. And throughout this conversation and throughout your work, you focus on technical analysis, and you make a relatively small number of trades to most traders, but you trade based on these larger trends that you've talked about. What is the overall outlook for the rest of 2026 here, and what do you expect to see the best returns, or where do you expect to see the best returns in the market? In other words, like, do you think you're just going to stay in cash for most of 2026 and let this kind of all collapse? Or do you think that there's a particular area that you want to be allocating more of that cash to as we get deeper into 2026 here?
Yeah, I think 2026 and 2027 are going to be very difficult. I think we'll be in cash quite a bit. I think we may, depending on what happens with interest rates, how the economy rolls over, what the Fed does, bonds, the bond ETF like TLT could come back to life. There could be an opportunity in bonds as the stock market falls for a little bit. There is also a good play potentially in the dollar, the US dollar index.